The dollar isn't collapsing overnight, but the world is quietly shifting. Nations are stockpiling gold, Bitcoin is rising as digital money, and the U.S. faces mounting debt it can't escape. The question isn't if the system changes, it's whether you're ready for it.
Hello everyone, this is BTC Insight, and welcome to yet another deep dive into BTC Insight. Before we jump in, make sure to hit that like button and subscribe if you haven't yet. You won't want to miss this.
Let's start with dollarization. It's a hot topic in media and finance circles, with constant speculation about the end of the dollar. But according to Lyn Alden, the reality is far more nuanced. Yes, de-dollarization is happening, but it's slow and gradual, not sudden or catastrophic. What we've seen over the past decade is that major trade surplus nations, countries like China, Russia, and others, are no longer accumulating U.S. treasuries the way they used to. Importantly, they're not dumping treasuries en masse either. Instead, they've shifted toward accumulating gold and diversifying their reserve assets.
De-dollarization is a complex subject because while it is happening around the margins, it's generally a lot slower than you'll see in a lot of media talking about it. Basically, it's kind of this period of time of the past decade where the major trade surplus nations are no longer really accumulating treasuries. For most of them, are not really kind of rapidly selling treasuries. They're just not really accumulating anymore. Around the margins, they've been accumulating gold instead, and just otherwise not rapidly accumulating reserves in general because they've been dealing with a stronger dollar environment, which generally means that they don't accumulate a lot of reserve assets. I think the biggest trends, facing this, what changed now is that one, we got past that period of kind of globalization and ever falling interest rates. So now we no longer have that interest rate falling offset. So if you double your debt, but you cut your interest rate in half, you keep your interest expense roughly the same. And going forward, they don't really have that falling interest rate structurally offset anymore. The other one, as I mentioned, is the demographics are totally different than they were in the 80s and 90s. And so while a lot of those calls for it in an acute crisis were premature, we've kind of reached now a lot of the things that those people were worried about back then. When you add all these other factors to it, around the margins, the fact that the foreign sector is not accumulating our treasuries, at least not at the rate that we issue them. And so their nominal amount does gradually go up over time, especially from the foreign private sector. Their percentage of total U.S. debt is generally shrinking, which puts more of the burden of accumulation domestically, either from the private sector or in some cases from the Fed during quantitative easing. So generally speaking, that means that more of the fiscal deficits are felt. But I generally view that the interest rates and the demographics are probably bigger factors than the kind of the de-dollarization that's happening. But over a multi-year, even multi-year decade time frame, that general trend of de-dollarization matters. I started actually writing about that it was 2020. And my view was that we are entering a more multipolar world in terms of currencies. So it's not as though the dollar gets usurped by some other fiat currency, but rather we get this kind of broadening effect of gold re-entering the system, and around the margins, certain countries saying, well, I'll hold a little bit of Chinese currency or a little bit of this other currency. And you have more of a plurality of reserve assets, of which the treasury is generally a slight loser in that environment. Punctuated by mini crises. Probably a really good example is that back in 2022, there was the UK gilt crisis. So they had a bit of a blow up with their sovereign debt. And people don't really talk about it today because it wasn't some massive generational crisis. It was like a blip that the central bank basically had to put out a fire and contribute to a little bit of inflation that was already happening. And now they still have an ongoing fiscal issue, but it's not the same as it was in 2022. Now they'll probably have one again of a slightly different flavor. And I think the U.S. is in a somewhat similar boat, which is that basically the background now is like 6 to 7% of GDP deficits, kind of a run-it-hot economy, especially if we're on the receiving side of those deficits, and punctuated potentially by little periods of crises. It could look like the 2019 repo spike. It could look like the 2022 gilt crisis. And in the U.S., we saw kind of similar but milder things where the Treasury started changing some of the ways it issues bonds. And so I think that's kind of how I view it. I've been actually using the phrase "nothing stops this train," which has both bullish and bearish connotations, because it basically means, one, virtually no attempt to slow down the deficit is going to work, which is bearish. On the other hand, it is kind of pointing out that it's also not going to derail in the next year or two or three. That this is going to be going on for most investment time horizons, which I generally, look out 5+ years on the longer end of my time horizon and say, I think this issue at least goes probably well into the 2030s.
So how do investors position themselves in this environment? This is where Lyn emphasizes the role of both gold and Bitcoin. Gold remains the timeless monetary metal, trusted globally with a history that spans millennia. Bitcoin, though only 16 years old, offers unique advantages: absolute scarcity, digital portability, and the ability to move value across borders instantly. Lyn often frames Bitcoin as a protocol for value transfer, similar to how the internet standardized communication.
Gold obviously has the long-term history and the irreplaceability as a hard physical money. Bitcoin is 16 years old, so it's newer than gold, but it has portability enhancements compared to gold, and it also has absolute scarcity. So over time, right now, for example, its supply growth rate is lower than gold. It also has certain kind of benefits of speed. So, for example, if we both had a Bitcoin wallet, we could hold up our phones, and I could scan your QR code, and we could make a payment right over this call. Whereas if we were to do something with gold, it would require a chain of credit and counterparties in this type of environment. So they have different pros and cons. And then especially when we consider that there's a global world. So in the United States, many of us don't think about crossing borders too frequently. But in many parts of the world, people are in Lebanon, people are in name the country that's having some sort of currency crisis or political crisis, and people might save their assets and want to leave with them, which is not always possible with other types of bearer assets or securities and things like that. So a self-custodial portable ledger is very attractive. I kind of view it like a new protocol. So there's Ethernet, there's simple mail transfer protocol, there's internet protocol, there's USB. There's all these kind of communication standards that we've kind of solidified around for many decades. And I view generally Bitcoin as achieving network effect dominance as a communication of value. So obviously it relies on our technological connectivity to varying degrees. It's robust to handle shocks. If your power goes out, you still have your keys, for example. You just can't transact in the moment. So it is quite robust, but it's a different system than gold. So I think that they serve different purposes. Bitcoin currently is around 1/10 of the size of gold. So you're talking about like a $2 trillion network, compared to like an estimated $20 trillion monetary network. And that's in a sea of, like $1,000 trillion worth of global assets. So, when major banks kind of look around and they try to estimate how much real estate's out there, and global equities and global currencies and global bonds and gold and art and Bitcoin and everything else, these are both kind of tiny percentages. And I think they're both growing into that much larger sea of assets. I think Bitcoin's moving faster because it's starting from that smaller base and it's younger. But they often go up and down at different times. And I've generally been long both. And one of my kind of recommendations, or the way that I've been doing it at least, is to say if you start with a 60/40 portfolio, that has some frictions in a fiscal dominance environment, especially the 40% bond portion. So my general view is, to tailor it toward a more debasement environment. If you swap out at least a portion of those bonds with gold, that's beneficial. You get kind of a similar volatility profile, but generally better returns. And you can also consider swapping in a portion of the equities with Bitcoin, where you have similar high volatility asset. It's been an attractive mix so far. So I'm bullish both.
To sum up, Lyn Alden's perspective is clear and balanced. Dollarization is real but slow. The bigger challenges for the U.S. are rising debt costs and unfavorable demographics. The world is shifting toward a multipolar reserve system where gold and increasingly Bitcoin play larger roles. And while crises will occur, they'll likely be managed in ways that keep the system limping forward rather than collapsing outright. For investors, the takeaway is simple. Recognize the environment we're in. Bonds are no longer the safe haven they once were. Gold and Bitcoin aren't replacements for the dollar, but they are powerful hedges and complements in a diversified portfolio.
That's it for today's look into BTC Insight. If you enjoyed this deep dive, hit that like button, drop your thoughts in the comments, and subscribe to stay on top of all the latest insights. Keep questioning, keep learning, and we'll catch you in the next one.